Good morning, Alex Cole, on this fine May 26th, and welcome to all of our Stock Charts viewers for this latest episode of GoNoGo Charts here on Stock Charts TV. How you doing, my friend?
Good morning. Yeah, it's been another wild week, but we seem like every week's wild at the moment. So let's go take a look.
That's right. When we look on a closing basis, you might just think nothing's happening, but the volatility is definitely still there. So let's dive in first, as we always do, this top-down approach just across the asset classes. What are we seeing from a trend perspective?
Yeah, so we're in the same spot we've been in. There's some weakness coming into these no-go trends, but again, is it a correction against the no-go or some start of something a bit more significant? We'll have to see. But you can see that the equity panel in the top is in a no-go. We've had a couple of stronger days today and yesterday. So you can see that no-go color is a pink no-go, which is obviously the weaker form of the no-go trend. Treasury bond prices, we're seeing that no-go trend weakening as well. A little bit of rallying there as we see treasury rates come off their highs a little bit. Commodities still hanging on to their go trend. The trends are still there in commodities, but we can discuss, which commodities are really driving those trends. And then the dollar as well, weakening this week, trying to hold on to its go trend. And then, of course, Bitcoin still struggling as well.
Absolutely. So just as a refresher, for those of you who've been watching the watching the GoNoGo show every week here on Stock Charts TV, what we're representing there is a composite blend of all of the technical indicators that you would likely use to understand trend. And when we blend those together, we get a color-coded factor. When we're in a no-go or a downtrend, the strongest form of that is going to be in the purple bars, or in this case, in a heat map, the purple bands. Weakness in a no-go trend, when we're thinking about bear market rallies, when there is a strong day price-wise to the market action, but we're still within that no-go trend, that'll weaken to a pink bar, and the weight of the evidence is still to the downside, but we're seeing that trend formation weaken. Same thing to the upside. Strong form of a go trend is in blue bars. The weaker conditions are going to be in aqua bars. So, Alex, what I've been hearing from a lot of analysts around the street this week is, looking for those early signs of change, and specifically the U.S. dollar, which has been so strong, that's been a real headwind to equities generally, and certainly to emerging markets. What are you seeing from a price action perspective as we look at that trend chart for the US dollar index?
Yeah, and it just to clarify, it's GoNoGo charts. Sounded like you almost said GoNoGo there, so we got to get the pronunciation right.
Exactly, go or no go.
But anyway, joking aside, yes, the trend in the dollar, this is the UUP, the dollar index fund, is still a go. The weight of the evidence says that we are still in a go trend. Now you can see that we have had a counter trend correction arrow that's been quite significant here, and we've seen a lot of weaker aqua bars. More concern is down here in the lower panel, in that the oscillator wasn't able to find support at zero, which we know it should, as you can see it did earlier on when the trend is healthy. So the weight of the evidence is we're in a weak form of a go trend, but there is some bearish momentum that we're seeing displayed here by the oscillator. So we'll see what happens.
Absolutely. Thinking back to the CMT conference, that the trifecta of negativity in this market was strong dollar, rising rates, and strong oil prices, leading to that inflationary regime. So weakness in the U.S. dollar could spell some constructive environment for the equities play. But let's turn our eye to the U.S. Treasuries, and instead of looking at Treasury bond prices, let's look at the yields, the TNX, and this is 10-year U.S. Treasury yields. Again, as we've seen over the years, when we have spikes in rates, that's really a headwind, particularly to the growth equity space. We've been talking all year about that rotation away from growth equities, sectors like technology and communications. We're going to get to that sector relative strength map here in just a minute. But Alex, from a trend perspective, if we're thinking about the yields, that line that you've got annotated there, that's a very long-term support level, going back to the 2018 highs. And of course, when we look at it over a much broader horizon with quarterly charts, we can see that goes back much further. So from a trend perspective, what do you see on the chart here of the TNX?
Well, it's become a very strong support level because of the resistance that it has provided historically. So this is the downward sloping trend line that we've seen, for such a long time on yields. Now, we've talked about this this year with the rising yields, how it was pushing price up to what was still resistance from a historically downward sloping trend line. Mm-hmm. We broke above that. So now we could expect this level to become support. Mm-hmm. If we really are in a rising rate environment, and we'll see higher rates and we'll be out of that downward long-term downtrend. But right now we're seeing some amber go fish bars on the daily chart, and we are seeing deterioration down here in the oscillator where it's fallen below the zero line. So as it's testing this support level, there are some things to worry about from a perspective of continued rise in rates. Now, like you said, any kind of pullback in rates could be good, perhaps, for stocks, especially those growth stocks.
Mm-hmm. Now, Alex and I are big fans of the life and work of Jesse Livermore. He talked about how markets trend and that there's a time to go long, a time to go short, and then a time to go fishing. And what he meant by that was the composite blend of indicators you're seeing in GoNoGo charts when you think about the weight of the evidence or going through your checklist. When all of those instruments are at neutral, the market's trying to figure out its next directional move. And right now, if we are on amber bars for yields, that tells us there's a bit of neutrality. Right now, in that lower panel, we're seeing negative momentum. So we're seeing a lot more selling in terms of the yields. So that's buying of government treasuries. And we'll see if this long-term resistance line, Alex, if you actually back that out to a quarterly chart, and we can see the 40-year picture, closing above this level on a monthly basis, certainly on a quarterly basis as well. If we are above that long-term sloping trend line, then certainly there is more to the upside as rates continue to rise. But if we're looking at it right now, we're just above that level. All of this rapid rise off the COVID lows has really just been a reversion to the mean, back to that long-term downward sloping trend line. But we're looking right now at whether or not this new regime has more upside potential.
And even on a quarterly chart, you can see some trend change, and you can see the uncertainty here. Most of the time during this multi-decade downtrend, when we've rallied back up to this level, we have seen a rollover, but remaining on no-go bars. We tried several years ago, and now again, we're seeing not no-go colors, but those amber go fish bars of uncertainty as we try to test and break out of this sloping trend line.
And I think it was John Roque and as well Jim Bianco who presented at the symposium about every time rates have been hiked up to that downward sloping line, we tend to break something. So when the Federal Reserve hikes interest rates, there is definitely some carnage to be had in the stock market. We're at that spot right now. But as we see some tapering off in the yields and we see some tapering off in the US dollar, let's check in, Alex, on the S&P 500, just the broad large cap equity index for the US, to see how that's playing out and what we're seeing in terms of the real short-term strength in this downward sloping market.
Yeah, so we had on here in our note this week this bullish divergence. We see the price making lower lows while the oscillator is making higher lows here. So this was one of the the earliest sign of something constructive. And then we noted how we were testing the zero line again from below. Now we've continued to rally so far this week, and we can see that these no-go bars have become the weaker pink color, but we are still below this recent lower high. So we're going to be watching this oscillator really carefully here, and as the squeeze builds up, we'll wait to see in which direction it breaks. If it resolves to the downside, we may well see price roll over and continue in the no-go trend. If it's able to break into positive territory, that's going to be our first indication that perhaps there is some undermining of this downtrend.
And now, Alex, you talked about a core principle of technical analysis. We look at price as our main and most important indicator, and that's why GoNoGo charts remove all of the extra lines and the analysis paralysis that can happen on a really crowded chart. We want to make sure that our eye is always watching that price action. but then we use other indicators to confirm what we're seeing from a price perspective. So in that lower panel, the GoNoGo oscillator, you mentioned a positive divergence. Just talk to us for a second about what you mean when price is making a series of lower highs and lower lows versus what's happening in the GoNoGo oscillator.
Yeah, absolutely. So what I'm talking about is here, we've got these lower lows in price and then not confirmed by the oscillator. We see the oscillator making higher lows when price is making lower lows. So what's happening there is price is moving down, but not as enthusiastically perhaps as it was before. So each low being made on price is being accompanied by relatively less bearish momentum. And so that's often a very early signal of a change in trend, but we must remember, being trend followers, that you can see multiple divergences when in a trend. So it's not unheard of or even unlikely for price to roll over again, and then this bullish divergence to have only been an indication of a short-term rally in price, not necessarily a change in trend.
And if you think about, the auction market that is all publicly traded exchanges, right? Fewer sellers at lower and lower prices. That's we're eating up some of that supply down there, and we see that positive divergence as potentially a constructive signal, something to keep an eye on, and certainly for everybody who has been hoping for the end to some of this selling, everybody who is positioned long or biased to the long side. Looking for any signal that maybe bottoms are in. Certainly, positive divergences are part of that constructive nature. But again, we look for the confirmation in price, and we see that trend change when GoNoGo changes color. So, Alex, moving on from the S&P itself and looking at that price action, let's look at the sectors of the S&P 500, not just on an absolute basis, but on a relative basis. So each of the sector ETFs divided by the index as a whole. So relative to the benchmark, how are things trending? And again, this is a declining S&P 500. So things that are relative outperformers may still be downward sloping in their absolute trend, but on a relative basis, they're going down less quickly than the S&P 500. What are you seeing from a sector RelMap perspective?
Well, so actually, we've been sort of saying nothing's changed for a lot, but there's a couple of things that are really interesting to me in this map this week. The first is that technology stocks, this is the top panel, have painted an amber bar here. So this is interesting because we were just talking about how the yields affect growthier stocks such as the technology sector. So if we were to see rates come back significantly more, that may well help the technology sector start to outperform. Now, right now, it's painting an amber go fish bar on a relative basis. The underperformers, along with technology, have been discretionary and communications, and they still are. The other point of interest, though, that I wanted to point out was that the financial sector, which has really struggled for several months, has gone into a weak go trend this week on a relative basis to the S&P.
Now, we can talk for for weeks about the financials sector and securities in there, but I know for the subscribers to GoNoGo Charts research, one of the things that we were pointing out were sort of the continued downside momentum for a number of those growth equities. And one of the words of caution to investors out there is that bear market rallies can be very tempting. I think it was Dave Lundgren who was sharing this week that it's sort of a good cop, bad cop situation. You're in a bear market and things are selling off drastically. When you get a little bounce, that's very tempting to spill your guts to the good cop because it's such a relief. But those relief rallies can really trap investors. So let's turn our eye to Netflix, which we've talked about in the weeks past as a security that had the glide path of a brick. Want to check in on that from a trend perspective to see if you're seeing the same kind of constructive evidence that we saw in the financial sector and then the tech sector as a whole. If we're basing or if we're even in a trend reversal, and it certainly doesn't look like it to my eye.
Yeah, I mean, and the other saying that's thrown around all the time, but I think is important that people keep in mind is that, the idea of don't try to catch a falling knife, right? So along the way, you can think this is oversold. You can think that this is good value. You can average down, but you could be wrong, right? There could be more destruction coming. And there is some slight bullish divergence here with the oscillator, where price is making a lower low and the oscillator is not. But what I would be very careful with Netflix is that, you really want to see something actual happening to tell you that perhaps it's different. And so right now we are building a go-no-go squeeze on the oscillator. So that is telling us that there's really little directional momentum at the moment in one way or the other. So we've seen the volatility shrink, and we will be watching the oscillator to see if it gets rejected by the zero line, in which case we may well see another leg lower.
Absolutely. We want to wait for confirmation. The big message from GoNoGo charts, if there is only one, it is that we do not forecast what the markets will do. Instead, we want to react responsibly to what the market is telling us. And right now, this is a series of lower highs and lower lows on no-go bars, and we've got negative momentum that's retesting that area of neutrality, building that squeeze. But until we see confirmation to the upside, we're not buyers, no matter how on sale Netflix might be. Right?
Yeah, and I think let's look at the middle of this chart again, just to sort of walk through how you might use this. Like, if you're trying to be super aggressive, you think. I mean, remember there was a gap before this that took Netflix's price, so much lower, and you've already seen such destruction of price. You might be thinking that there's good value, and you are waiting somewhere in here to be a buyer of Netflix. Well, we did see the oscillator break above zero. And so that's our first, okay, maybe that's not what should happen if this no-go is strong. But if you look at the price action, we got an amber fish bar, then we went back to no-go. We got another amber fish bar, go fish bar, and then we went back to no-go. And then the confirmation that this wasn't the time to buy was when the oscillator then went back below zero and gave us a relatively low risk no-go trend continuation icon before obviously the second gap down. So you have to keep the weight of the evidence sort of in the forefront of your mind. And the price is all important, like you've said so many times. These are indications that you may want to get yourself ready or set yourself up. Or if you do want to be early, then go ahead, but set your stops. And in this case, you might say, okay, we've seen an amber go fish bar. I'm going to take a position. But when you see a no-go trend continuation icon here, purple bars, oscillator back below zero in negative territory, then you're no longer seeing those reasons to be bullish, and you would hopefully have been out of any kind of early long trade. So we're sort of at the same situation here, waiting to see if we get back into positive territory, if there's any kind of color change above, but all else being equal, let's wait and see what happens with the oscillator and the squeeze.
Absolutely. And that large gap down was, at earnings reporting, missed their mark, advised lower on future earnings. And so we don't know what's going to happen when companies report. There's no insider information over here at GoNoGo charts, but we can follow our discipline. And that is that it was in a no-go with negative momentum ahead of that earnings announcement. So holding on to something that's in a no-go trend, that's just a really risky behavior and breaks all the rules. So let's move on from Netflix. The other ticker that I just wanted to pull up real quick was Nvidia. A lot of discussion about that destruction in the price chart, as well as a lot of folks looking to buy something on sale. So strength this week, the last couple of days. What are you seeing from a trend perspective, Alex?
On first glance, it looks a lot like the chart, the S&P, right? We had this rally earlier, which was got us into a go trend, which we got quickly out of, sort of at similar levels to what we got in. And then we've been in a strong no-go since. Now, we're watched strength in the last couple of days, much like the S&P, also testing the zero line from below, much like the S&P. We rallied off the couple of weeks ago low. But we are watching the zero line. If this holds as resistance, we would look for price to roll over. If it doesn't, then same conversation that we're having with the S&P.
Absolutely. And we're going to be checking in on all of this every week with the GoNoGo show. When the bottom is in and we see strength in growth equities, you'll hear about it here first. But that's enough bearish talk for one day, Alex. Let's turn our eye to some of the things that are working, things that are in the portfolio that continue to show durable trends. Now, a lot of the commentary I've been hearing from Wall Street analysts is that commodities have made such a strong run. We're approaching these areas of, some overhead supply going back to the '08 timeframe. But if we pull up a chart of Boyle, that's a Nat Gas Futures ETF from Invesco. What went out to subscribers was the notice that there was a return of momentum, a resurgence of momentum in the direction of the trend. So on Monday, we saw that green circle appear as the GoNoGo oscillator popped off the zero line back to some overbought territory. So what are you seeing on this chart right here, Alex?
I think that the is what we always talk about is that the sort of the cornier sayings from our discipline, like the trend is your friend until it ends, and be on the right side of the trend. It's in play until it isn't, and I think that's the key. You can think that we're very overextended at this point, but until you're given clear information to tell you that the trade isn't working anymore, as trend followers, you want to continue to trade in the direction of the trend. And so when we were looking at Boyle, we were seeing the continuation icons here piling up, and we're seeing the oscillator find support at the zero line. And then this one on Monday was with a closing price of 120, and then we've traded up this week to 130. So continuing to work. You can speculate that it's overextended, but it isn't until it is, if that makes any sense at all. And we are actually now closing above the high close from last month. So it's still in play. The trade is still working, and that was, I think, the point of that.
And I think technical analysis has long held a strong position in portfolio managers' discipline for the risk management aspect, and nothing manages risk better than technical analysis. But I think it was Jeff DeGraff in last year's podcast with the CMT Association who said technicals allow you to play with fear and arrogance. So you have a strong risk management discipline, but part of the reason people need to stick with these trades long after you might believe it's overextended or it's too expensive from a fundamental perspective is that the duration of trends, right? As portfolios get rebalanced, as the narrative makes its way into the financial advisor network and they're rebalancing portfolios on a 3-year time horizon, commodities are now starting to outperform on a 3-year basis. So when you think about allocations, and you think about money flows, the duration of trends can be very much further extended than most folks would believe. And so what I think Jeff DeGraff was pointing out, and Frank Teixeira and others, is that technical analysis has a lot to add in terms of alpha capture. And so we can stick with a trend much longer. We can be more patient holders long after our belief may tell us that it's too expensive or it's overblown, overdone.
I think it's another way of saying, like, we always talk about how everybody's too fearful at the bottom and too greedy at the top. Yep. But technical analysis allows you to play with fear and greed.
Yep.
And it's another way of saying it, but it's exactly the same thing.
Yeah, and to play off of the irrationality of markets. Excellent. So let's turn our eye to another chart. Occidental Petroleum, OXY is the ticker. We're going to look at this on a daily and a weekly basis because we're seeing new highs and we're seeing the resurgence of momentum. Alex, talk to us a little bit about what's happening at the zero line as we strike these new highs.
Yeah, so the same idea. The trade has been in play and it's been working pretty much the whole of 2022. We know that. So here's another oil company. Is it overextended? Is the trade over? Well, we're now consolidating above multi-month highs. If you can see my cursor here, we've consolidated sideways pretty much since we had these short counter trend correction arrows back in March. But now we seem to be consolidating, if you can see my cursor here over on the right, consolidating above those highs. And so what we saw this week on Monday was another go trend continuation icon. And then we've actually had another one yesterday. So now closing, if you were to zoom in on this, again, just like we were seeing with Boyle, we're on a closing basis, we are at new highs. And so you can see the general trend of price. You can see the higher lows as we move up here. If we can make a higher high here, trend absolutely still in play.
Absolutely. And if we pop that out to a weekly basis, just to see the long-term trend of this Occidental Petroleum chart, actually, let's back it up even a little bit further, Alex. You can
Sure.
consolidate. There you go. Coming off of the COVID lows and coming back, haven't even approached the prior highs.
Right, negative oil prices, right, after all that. And you can see, you know, on the weekly chart, this resistance level here that was support further to the left, that was cleanly broken, retested, and now we're making new highs on heavy volume. So these trends that you talk about when you're discussing how people might be rebalancing their portfolios on a slower time frame, that's why people think that these trends may be around for a while in the commodity space.
Absolutely. Thank you so much, Alex, for walking us through the charts this week. Appreciate all of you watching us here on StockCharts TV. If you're on YouTube, that's great. Subscribe, and hopefully you enjoyed this video. But also, I wanted to invite you all to join Alex and I on June 15th at 5 p.m. Eastern for a special GoNoGo workshop. We're going to walk through the ideas of trend, momentum, volatility, and volume. We're going to talk a lot about the concepts of relative strength and what we've seen throughout the first half of 2022 and what we're watching forward to in the rest of the year. So thanks so much for joining us. We'll see you every Thursday afternoon at 3:30. Be well.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.